Afreximbank has disbursed $925 million to Nigeria's state-owned NNPC, part of a syndicated $3.3 billion crude oil-backed repayment or prepayment facility. Now, this brings the total disbursements to Nigerian National Petroleum Company, that is NNPC, to $3.175 billion. This is against the backdrop of international financiers that are meant to fund the construction of about 20 modular refineries in Nigeria, withholding their funds due to the challenge of getting guarantees for crude oil supply to the facilities when they are completed. So we have Afreximbank, IOCs and domestic refiners jostling for Nigeria's limited crude. So what is the way forward or the way out? This morning, Esther Otusanya, Senior Investment Research Analyst at Meristem Securities Limited, joins me to shed more light on this. Thank you so much, Esther Otusanya, for joining us on the show.
Thank you for having me.
So we start with the crude swap deal between Afreximbank and Nigeria. Now, Afreximbank claims this is the largest crude-backed facility given to Nigeria. So what's your take on this? What do you see in terms of the potential impact of this loan to Nigeria's sector and, of course, the economy?
Okay, thank you for the question. So we know that NNPC secured this emergency repayment loan from Afreximbank since last year, and since then we've seen about $3.2 million, $2 billion being paid, inclusive of this $925 million. So the potential impact of this funding is twofold, but they are quite complementary. The first is to provide dollar liquidity to the government to be able to rescue the naira, which has been on that depreciation trend since the liberalization last year. And a major reason of this is just the limited supply of ESD. So with this loan, the government can seem to improve that. And secondly, it is for an upfront payment of taxes and royalties for the federal government, which can be targeted at revitalizing the oil and gas sector that is in need of their investment. So amid the series of reforms in the oil and gas sector, the loan can actually be quite instrumental. The funding can be used for investment to improve the existing and even future resources, which leads to more oil and gas production and eventually feeds to more dollar inflow for the country and the stabilization of the exchange rates.
Yeah, so let's talk about the stabilization of the exchange rate. We know that the loan was being sought by NNPC to aid the government in stabilizing the naira, with about $3.175 billion already disbursed. So how effective would you say this loan has been in achieving naira stabilization in terms of its goal, considering the fact that the naira keeps appreciating today, depreciating tomorrow? You know, we see the fluctuation. Do you think that this particular fund or this loan deal has helped in any way?
Well, truly, it has helped, because when we look at the direction of naira since last year, there's been that spiral depreciation. But recall that earlier this year, around February, March, we saw that sharp fall to almost 2,000 naira to $1. But we see the Monetary Authority has been on the forefront of preventing this. And truly, the different tranches of this loan has actually boosted the government's ability to carry out some interventions in the FX market, which has helped to supply that liquidity that is needed. So really, the loan has been quite instrumental. I mean, even we've been seeing that, just like you mentioned, that movement in the in naira's value, the appreciation, the depreciation. So, but we haven't seen that sharp depreciation exceeding a particular range. So I think the inflow from the loan will be quite useful to maintain the naira within that range.
Now, we know that Afreximbank played a key role, a big role in arranging for this loan to be made available, and of course also encouraging oil traders to provide these funds. Now, how does this deal benefit Afreximbank's position as a Pan-African lender? Are there potential risks that we are not even seeing that Afreximbank might be involved in, because it's a large-scale loan, and if it goes south, of course, there might be losses incurred, and I believe Afreximbank will not want to be in that position?
Well, truly, the Afreximbank, there are risks like associated with this deal, but really this more strengthens Afreximbank's position as a Pan-African lender, as you mentioned. I mean, it's quite a complex deal, really, and it's to be able to arrange this kind of complex financing structure. It just means that it's strengthening the bank's position in that side. But when we look at the risk associated with the loan, I mean, as of last year, when the possibility of the deal was announced, there was some stalling, like because some investors pulled out of the deal initially. But since then, we've seen many developments in the domestic economy, which has kind of affirmed Nigeria's crude oil production outlook towards the positive. So I mean, the country's oil production is a major determinant, really. But since we are quite positive on the direction of that, on the direction of the repayment, I think the risk of repayment for Afrexim is minimal, and even considering the fact that the deal is backed by foreign is backed by future production output, not like it's cash based or fund based. So I think that as well as kind of like minimize the risks of defaults from Afrexim point of view.
But we see that when you look at the capacity that Nigeria is generating in terms of crude now, well, we've been able to eat about 1.7 million barrels per day, thereabout, but then it falls short of what Nigeria is expected to supply to IOCs, by IOCs rather, to either domestic refiners or probably for exports. And now we have an Afreximbank who is also demanding crude. So do you think that Nigeria will be able to meet up that capacity?
Okay, well, truly, of recent time, we've seen, like this year in Q1, we saw that month-on-month basis, on a month-to-month basis, we saw that slowdown in production output, and this is just due to some terminals not being in operations and some other operating like backstores. But for the near term, we expect the oil production for Nigeria should actually increase, because there's been a lot of positive triggers that we expect to drive this, that we expect to drive the production. And for one, we've seen a lot of terminals come back into operations, and with this, I think we're even on the right direction. We are towards the right direction where production outputs can actually increase. So in the near term, we should see that significant increase in the country's production output, and I don't think that should be a major issue for the loan or for the repayment of the loan in general. I mean.
Of course, still talking about the loan. Now, this loan is part of a larger effort by Nigeria to attract foreign investments. You've mentioned it in passing while you were talking, but then what are the potential long-term implications of this strategy for Nigeria's economy development? And of course, when we talk about self-sufficiency.
Okay, for Nigeria, I mean, it is a larger effort by Nigeria to attract foreign investment, and one of the major impacts will be the signaling effect. The ability to be able to secure this loan from Afrexim speaks to the credibility of the nation in general, to be able to like get investors to supply give out this loan. And given that Afrexim received this funding commitment from investors, not just on its own. So I mean, it speaks to the outlook of Nigeria in general. For the self-sufficiency in the oil and gas sector, the country is on the right path for that, and the main focus should be on the efficient execution of the ongoing reforms in the sector. Like I mentioned earlier, for Nigeria, this loan is actually it's quite positive, even seeing the repayment structure that it is benchmarked on.
All right. Well, we understand that Nigeria has a history of external debt running into trillions of naira, and there are concerns about the country's ability to service its debts in the long run. You said it's a positive light for Nigeria, but then focusing on the terms and the crude value equivalent, do you think that this new loan would have any impact on Nigeria's overall debt burden? Do you think it would reduce at the long run?
Well, for Nigeria, really, the debt, just like I mentioned, the loan is not to be repaid by cash on a cash basis. It is more benchmarked on the future oil production. So the repayment structure, we are not seeing a direct linkage to an escalation of the debt stock of Nigeria as a country, but it's more of an indirect. Impact, really, because when we look at the possibility of the future proceeds that has been pledged, it means lesser funds are available to carry out the budget expenditure by then. That's for the foreseeable future. So looking at the positive side, although there's been a lot of policies and focus to deepen maybe tax collection and revenue generation, which will provide more of sort of a balance, despite the commitment of 90,000 barrels per oil, of oil per day that is pledged to the repayment of the loans. So really, I don't think there's a direct impact on the escalation or the increase of the company's the country's debt stock in the near term.
Okay, so let's now look at the other shade of it, and that has to do with modular refineries and how investment or growth can come to that particular arm. Now, there has been the huge clamor for investments in the oil and gas sector, but now we hear that investors are hesitant to fund the building of about 20 modular refineries because they are worried that the refineries won't have enough crude oil to process once they're built. Now, this seems to be a growing concern with, of course, we know Dangote that also had to outsource crude oil for refining. So what is your take on this?
Truly, I think even since last year, there's been that talk around refineries not being able to source crude locally. And last year, with the commencement of Dangote Refinery and some other local refinery, the Nigeria Upstream Petroleum Regulatory Council actually issued a compulsory domestic crude supply obligation to upstream companies to supply refineries crude oil of about maybe 483 barrels per day for H1 this year. And this is just aimed at bolstering domestic refining capacity. But we've seen that despite that issue, we've seen that there's still that slowdown in supply of this crude. I think really what needs to be done is more more focused on trying to ensure that the agreements between the upstream and the refiners are actually more transparent, yes, and more transparent. So because if it is more transparent, I think the upstream companies will be, the upstream company, that's the crude oil producers will be more open to, reaching maybe a forward agreement with refineries concerning the supply of crude oil. And we see if this doesn't actually, if this continues in this line, it has the impact to it has the impact to reduce the refining capacity of the local economy. But with Dangote Refinery and some other larger refineries, we can see that, it is still at a point where there is no cause for alarm. But really, the modular refineries are quite as important as the big refineries, really, because they kind of like help to stabilize that demand. Imagine if there is a disruption in maybe a major refinery's operations, the modular refineries can step up to help to regulate without causing much of an impact into the supply in the local market.
Okay, well, we've actually given a bit of solution to this, but let's look at this particular other solution that has been proffered. Now, we know that modular refineries, or refiners rather, as well as some downstream operators, according to reports in the sector, have repeatedly called on the regulator to mandate the IOCs to supply crude to the indigenous refiners first before exporting the commodity. But the regulator has been coy on this. Now, can such a standing order clear the bottleneck to hasten more investments in the building of the completion of more modular refineries? Because the standpoint is the modular refiners need financial capacity to be able to build their facilities to make it 100% before they can get crude for refining. But these investors will not provide the funds if they are not sure that when these facilities are made available, the NUPRC will be able to ensure that there is enough crude for these refiners to work with. So we kind of have a challenge with that. But if there's a standing order that, okay, once these facilities are built, make this particular commodity available for these refiners. And when the investors see that, okay, this is viable, they can get returns from it, this is workable, then they'll be able to put their money on it. So do you think a standing order could work in this situation?
Okay, yes, a standing order would actually work, but before a standing order would work, there has to be a lot of agreements put in place already, a lot of structures here put in place already, and well, truly we've been seeing that focus of the fiscal authority and regulatory bodies in the oil and gas sector focused on driving that change in the oil and gas sector. It won't happen at a go, really. It won't happen at a go. There has to be a lot of incentives that will ensure that the production at the upstream level is at optimum levels, is at optimum points, and I think that's the attention that the government is trying to come from before the government can propose or stand on their directive for the upstream companies to supply the refineries. I think there has to be even some reforms in the upstream level that can even spur investment to the upstream level. So if production at the upstream level is very buoyant and at such very high level, I think pledging to the downstream, pledging to the refineries, it won't be much of an issue. And truly, from the direction of the new administration and even the 2024 oil and gas regulatory action plan, we see that they've outlined a lot of key variables in order to just ensure the production capacity of the country. And we've seen some the likely conclusion of maybe bidding rounds for some deep offshore oil and oil block licensing. And there's also been that pursuit of strategy to optimize the unit of production for oil and gas. So, I mean, if the upstream company, because the upstream sector really drives the entire value chain. Okay. So if the upstream sector is if investment is flowing into the upstream sector, I think it would eventually feed to the refiners as well. And even seeing that recently, the government introduced fiscal incentives that are designed to kind of just optimize how much the sector is attractive enough for investment. I think these are really major things that can ensure that the sector as a whole is moving towards the positive direction. So I think it is not just about ensuring that the IOCs pledge towards supplying the refineries. I know it is important. The refineries are very important for the entire value chain as well. If not, we won't be seeing scarcity of oil and all of those. But at the stage that we are now, the implementation of reforms cannot be all through. It has to be measured. So measured reform and execution of reform will actually feed to actualization of the main goal.
Okay, basically there's a lot of potential in that sector, but then it all boils down to policies and the way they are being implemented. Esther Otusanya, Senior Investment Research Analyst at Meristem Securities Limited, thank you so much for your time on the show.
Thank you for having me.